Hello and welcome to this MBL webinar on fund accounting and carried interest. I hope you enjoy it, and we're going to cover quite a few areas in this relatively short webinar this morning. So we'll have a look at, first of all, the structure of a private equity fund, just as a reminder, before we get into the actual detail between general partners and limited partners and start looking at the accounting. We'll also have a look at carried interest, and we're going to look at the valuation of portfolio companies as well, and also how private equity firms measure their returns. I'll show you some examples of typical private equity fund account structures right at the end also. So if we just first of all have a reminder of the funding process. So if we are going to be setting up a private equity fund, we need a private equity organization to effectively manage the fund. And the fund is going to be raising finance from institutions, typically pension funds, banks, insurance companies, endowments, family offices, sovereign wealth funds, and so on. And these will typically be limited partners, which I'll explain more about in a second. So hopefully, when we set out our strategy of the fund to these investors, the limited partners, they were going to commit money into the fund. And we'll have to determine our strategy for the fund to start with. And we'll need to know, for instance, what sector we're going to be investing in, or indeed sectors, what geography we're going to be invested in, and whether we're going to be basically a venture capital fund or a management buyout fund typically. Having raised the money for the fund, then we can start investing in underlying companies, as set out in terms of our strategic analysis to the investors. So if we told them we're going to be investing, for instance, in software, then we must invest in software companies. We will then be working with those companies to help them grow, and over the course of the next few years, hopefully they will indeed grow, and we will be able to be in a position to start seeking an exit for those investments, usually through a trade sale, or an IPO, or maybe a sale to another private equity firm, possibly. And when we do exit from those investments, the cash will go back into the fund and is then returned to the limited partner investors, generating their internal rate of return. Now, this whole process usually takes about 10 years, which is the typical life of a private equity or indeed a venture capital fund. You can extend that by 1 or 2 years if the limited partner investors agree to that. So that is the basic sort of funding process, and we have to account for all those activities with the cash and commitments coming in from the investors, the limited partners, into the fund, and then into the investee companies, and then being returned back into the fund and up to the limited partners. This relationship between the limited partner investors and the general partner is one where basically we aim to share the risks and rewards of this activity. And we need to align the interests between the LPs and the GPs. This is all set out in the limited partnership agreement. It will cover such things as how much management fees we're going to be receiving as a general partner running the fund, and what sort of level of commitments we want from the LPs into the fund. And also the general partner will be required to make a commitment, usually 1 or 2% of the fund total.